You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thanks for tuning into Mining Stock Education. I'm your host, Bill Powers. It's been 3 months since we spoke last with Shubham Garg. He's an oil analyst and investor over at White Tundra.ca. Coming back on the show today to talk oil macro. Shubham, welcome back onto the show. And there's a banking crisis in my country here in the United States, but because the world's interconnected, it affects everything. And one of the results is that the oil price has been selling off the last couple weeks. What are your thoughts on this, and how does this affect your investment portfolio in particular, please?
Yeah, you bet. Great to be back, Bill. Thanks for having me. Always fun to chat oil and gas. So I think this is one of the things that, unfortunately, we oil investors have to deal with. We have our structural bullish undersupply thesis on the one end, but then we have the global Fed, which is following what the US Fed is doing, hell-bent on reducing inflation, but in the wrong way. Instead of doing things where they invest more in the supply, they go and fix up the supply chains globally. What they're doing is, hey, we'll just raise rates and lower demand, and the people can deal with it. And unfortunately, they don't seem to have realized that the raising the rates has a chronic effect on the economy over a longer term. It's not we raise rates today and all of a sudden, like a video game, things just change right away that day. So what they've realized, I think, at this point is maybe have raised a bit too fast. Some of the banks have come under pressure from people pulling their money out. I do want to make this point very clear that the two banks that have gone under or are going to go under in the US have been mostly crypto heavy, aggressively tech focused banks that have taken on exposure maybe they shouldn't have. And then the other one has been Credit Suisse, which if you follow the stock price of Credit Suisse in the last 10 years has not looked very good. So the banks that are really under pressure are these highly aggressively focused banks. The rest of the banking industry seems to be in a much better place in terms of their liquidity, in terms of their debts they've taken on. When you compare them to 2008, they were lending out, I believe, $23 for every $1 in deposits. Now that ratio is 5 to 1. The deposits they have and the lendings they make are a lot better as well in terms of where they're allocating that money. So looking good from that, but we are in the blast radius. When these sorts of events happen, everything sells off, and commodities are one of the first ones, given just that they're easy to sell. There's a lot of margin there and liquidity there that can just be dumped on the market without care for sort of what's happening. And I think for the viewers, if you just pull up a chart of open interest in WTI contracts or Brent contracts, we have been relatively lower anyway, which means that when there's a event like this happens and a few contracts are dumped on the market, they make a much larger impact on the WTI price, where you can see $3, $4, $5 moves in singular days. Nothing in the physical market has changed, and maybe we'll get to this as the interview continues on. But really, for my portfolio, I have been lucky in that in the last few weeks, I had reduced a little bit of my margin position. My margin exposure now is about a third, as it was in June and July of last year. The big reason for this, of course, is the interest rate was going up. So I'm paying about the same in interest right now on the 1/3 margin than I was back in June last year. March to June last year, when we were in still a relatively zero interest rate environment. So really has protected me on that. I also find that some of the junior companies have been able to sustain the drawdown a lot better. And as the viewers maybe know, I have moved my portfolio to more into the junior companies, which can't be margined anyway because they're under $3 or $5 a share. But also the holders in these companies are investing for a reason. They're not investing just because they felt like buying these. They understand the cycle, they understand the companies, they understand the growth profile. And so these companies have sustained the pressure, the selling pressure, a little bit better as well. So overall, it wouldn't be a surprise to say the portfolio is down than it was 2 weeks ago. obviously. But at the same time, I've been lucky this time that there has been no margin calls. I've been able to sustain it very, very well. And then some of the recent gains, I would say that some of the companies have been making have been able to counteract the more recent drawdown that has happened. So I myself am very happy with the price action in the equities, given that we went all the way down to $66 a barrel. If this happened 2, 3, 5, 7 years ago, the entire bottom would have fallen out and you would have seen massive selling pressure. But the companies these days are just in better shape. The shareholders are more aligned with the cycle. And also the companies have less debt. So the value remains in the equity of the company as opposed to transferring to the debt in a drawdown scenario that we've seen over the last 7 to 10 days, let's call it.
So Shubham, in your outlook from the supply demand for oil, could the situation right now with the banking crisis as it caused oil to sell off, and if there's an economic downturn that is more marked this year because of what's going on, could that just prolong or push back your bullish outlook on oil?
Yeah, so this is a double whammy effect that happens here. The crisis we see right now is real. As to the impact of that and how many people get unemployed or lose their savings, that's one factor. Yes, the reality of it is if you go look back into 2007, 2008, we had I don't want to compare the two events, so I'm just wanting to use the oil price as a proxy. What happened in the oil price was not because of physical demand in 2008. Oil wasn't suddenly worth $147 a barrel and then worth $30 a barrel a few months later. It was a lot of it had to do with financial metrics. Certain banks got caught short oil. Certain banks had to then dump their contracts when the actual event occurred. And you might see a similar pattern develop now. We have way less liquidity in the markets, which means that if this banking crisis gets a little bit more out of hand, you could see a lack of trust in the markets develop, where banks are just forced to sell contracts. Other entities are just forced to sell contracts. And so it puts pressure on the financialized WTI market without it making an impact on the physical market. I think the physical market is still very good. Over the last 6 or 7 weeks, we've started to see draws now on worldwide global crude, which tells me the market is getting even tighter despite WTI price going lower. So from that standpoint, I think we're good. The Asian market is picking up the barrels a lot faster than what the North American market is dropping. We're getting some early indications of spring and summer travel so far this year, not seeing any major impact from this banking crisis. It's more a localized event that's happened. It affects the financial market more than it does the real world. On the other side of all of this, when I talk about the double whammy impact, is when you have crude price fall below $80 a barrel, let's say, what you saw was rigs were starting to drop in the US. We saw the rig count go up, and then it didn't even flatline. It just immediately started dropping. We saw the frac fleets are now relatively flat year over year compared to last year, where they were up 50, 100 frac fleets year over year. So there's a real impact to the oil supply when prices fall below what I think right now is a sort of break-even new project price of $80 a barrel with the cost inflation that we've seen within the service industry in oil and gas over the last couple of years. So what does that mean? That means production is dropping. Because the rig count started dropping 3, 4, 5 months ago, then the frac count started dropping. Now it's production that's dropping. Permian production is down 250,000 barrels per day in just the last 6 weeks. When you have this short cycle shale production, high decline is your marginal barrel in the market, and it starts declining at these rates, you're going to see a real impact of these prices in a month, in 3 months, and in 6 months. And this is one of the things that investors should really, be focused on is oil prices are not moved in a vacuum where supply demand stays the same no matter where oil price is. They have a real impact. It just takes 3, 6, 12 months for that impact to show on the market. So we're seeing supply not go ahead as much as what was predicted. You might see similar changes in other supply that people are bringing online in Canada, in Brazil, in Iraq, in other parts of the world. And also, to have a third whammy on this is that when prices go lower, people consume more petroleum. What you see is, okay, let's say you're booking a flight for your family to go and visit Asia, and prices were 50% above what you were paying pre-COVID. Maybe you say, hey, let's wait a month. We'll see summertime. We'll see fall time. Now with the drop in prices, the flights are now 20% over what you were paying pre-COVID. And you say, okay, honey, let's book the flights. Let's also take the kids along with us and let's go, right? So there's a real demand impact. Maybe you were booking a road trip and gas was $4 a gallon. Now it's $3.25 a gallon. You decide to go on your 6-week-long road trip throughout the national parks of the US. So there's a real impact both ways that further creates an undersupply going forward. And unless the world is ending in the next few months from a global financial credit contagion, there's a real impact to this going forward on the physical market. And hey, the bullish thesis has been maybe pushed back a couple of months. But on the other side of it, what is going to come is getting higher in terms of pricing, and it's getting longer because the supply cycle also is getting pushed back. At the same time, demand continues to go up. So the main question really now is, can you survive this drawdown? Because whatever's coming on the other side is getting higher and is getting longer. And that's the thesis, I think, is your structural bullish thesis, which takes time to play out. It's not a 3-month cycle. It's going to be a 5 to 7, maybe even longer year cycle at this point.
So the outlook is good for medium to long-term oil investors. But in the near term, you mentioned surviving this drawdown. Are there any metrics or guidelines that you're employing in your own portfolio to survive this drawdown? What happens if we see $40 oil? What happens to your portfolio? How would you manage that?
For sure, yeah. Great question. I think if any of the viewers think that there's a, call it more than 2, 3, 5% chance that we stay at $40 oil or that we even get there, I would not be in oil equities, because it doesn't matter what the break even of the company is. If oil price really got to that, you will see catastrophic losses in your share prices going forward. So definitely keep that in mind. The one thing I will say from my perspective, from some of the other oil investors' perspective, and this is not me patting myself on the back, this is showing you the way I think, is that we're already up 1,000 to 2,000% in the last 3 years. So there's a bigger margin safety net, let's say, because we're sitting on a lot of house money rather than our own funds, which would be some of the newer investors who are in the space. So you have to think about things differently depending on which bracket of those you fall into. And given sort of the fact that, again, house money is still my money at this point in time, it's not just free money that's sitting there. You still have to be very cognizant, very careful. I myself, as I mentioned, have trimmed my margins significantly. I'm also more in some of the junior companies. There are other companies that are hedged at $85, $90 a barrel, which one could look at possibly going into. And also the lower decline, lower capital companies. Any company that can cut capital without having a major impact on production would be ones that are able to sustain that for a little bit longer. That being said, $40 a barrel, even if it is here for a month or two, is going to have a permanent impact on some of the US shale companies. They will go under because they don't have the right acreage. Their production is going to decline all the way to basically zero. And when I say they go under, not that they're going to go bankrupt, but they will literally run out of acreage and have no production coming out the other side when they would really be able to make money off the higher oil pricing. So keep that in mind. When a company goes under, it doesn't have to be due to financial reasons. It could be due to geologic running out of acreage reasons, and then they have no money to go and acquire more land or do more drilling. So definitely one of the ways to avoid high decline, high capex companies like that, a way to go through this And also just watch your margin. Anybody who's trading on margin, be very, very careful. Understand the risk you're taking on, because really you could have a very short period where prices go down. And by very short, I mean less than a week or 2 week period where prices drop. That could knock you out from your investment portfolio. At the same time, if you can time it properly, and I never condone timing markets, but the upswing on this is also going to be very, very violent. If the physical market gets so tight that the barrel cannot be found, it will start pushing oil price up despite any sort of credit events. And hey, guess what? The Fed meeting is tomorrow. If Mr. Powell says, hey, we might pause here or provides commentary to that extent, and the physical market gets tight, there is $5, $7, $10 trillion in money market funds, plus all the cash people are sitting on, waiting for a pause in the Fed. You could see a massive move upwards on that sort of commentary. And I'm not one to advise people what to do. I think just understand the risk reward you're taking on, which to me, from an oil standpoint, at $66, $68 a barrel is absolutely fantastic. And I continue to be just about fully invested with a little bit of margin room in terms of buying power going forward.
Shubham, everybody knows you like Canada to find your oil plays, but I was approached recently with a Venezuelan private co that wants to move into Venezuela, which they say is opening up. Your thoughts on this?
Yeah, very interesting timing, given the Venezuelan oil minister just resigned, I believe yesterday or a couple of days ago, for stealing $3 billion, was it, of funds? So
communists steal a lot more than that, but yeah.
yeah. Maybe a higher percentage was also lost, let's say, not stolen. So look, I'm all for oil and gas development. I'm all for supporting companies that are going out there, taking risks and developing. There's also money to be made in supporting these companies. But the question is, why? If companies in Canada were trading at 10, 15, 20 times cash flow, yeah, it makes sense to go and take a risk at a Venezuelan company trading at 2 times cash flow. And they're going to bring production online and do all this. But the same opportunities exist within Canada. There's companies trading at 3 times cash flow. There's companies trading, if you're now, bring it up to $80 strip pricing WTI, there's companies trading at 20, 25, 30% free cash flow yields. So when I can get that sort of exposure in a more stable climate, the question really becomes, why take on that risk? If the reward justifies it, maybe there's a case for it. I so far have not found this. And, let's just discuss maybe briefly some of the exploration plays that have not done well. They have got absolutely shellacked. We're talking about Recon Africa. We're talking about Eco-Atlantic oil and gas. We're talking about some of the other plays offshore that have failed to find any discernible quantities of oil. And we're also talking about some of the North American plays where the valuations went way through the roof on an exploration project and now have come down to more reasonable numbers. So, FOMO and exploration risk is worth taking on when your producing entities are trading at much higher multiples. We're not there yet. We are still trading, call it 50 to 75% cheaper on a cash flow multiple than we were in 2012 to 2014. So while that opportunity presents itself in North America, especially focused on Canada, low decline, you have the exchange rate, 35% bonus, you have a stable climate with known royalties and known companies that are not going to pay corporate tax for the next 3 or 4 years because they have the tax pools. That's a great place to be. And any email I get or Twitter message I get about any other entity outside of that, I hear them out. I hear the story. At the end of the day, what I give them is a Canadian company, and I say, tell me why I should buy your company over the Canadian company. In a lot of times, it's silence or an answer that makes no sense, and we sort of end the meeting there respectfully.
And would you do the same, like if it was a offshore drill play versus a onshore drill play?
Well, so I think offshore is definitely,
unless you do horizontals from shore out into the pool.
Yes. Offshore is a is an interesting beast because offshore gives you wells that produce 10, 20, 30,000 barrels per day, or the equivalent of gas, right? So there is upside, I think, in offshore plays. Deep water drilling is going to be your source of supply going forward, your source of stable, low-ish decline supply going forward. So, I'll kind of leave it up to the individual investor. I don't personally look at offshore plays, but if I was to compare, let's say, a onshore Colombia play to an offshore play somewhere else in the world, I'm more attracted to the offshore play because if you hit, you can hit big time, big time. One of the most recent examples I can give you is the Lundin family that discovered the Johan Sverdrup field offshore Norway. This field is now producing more than 500,000 barrels per day out of a very small little discovery that was initially missed. Another company drilled mere miles away from it, but they weren't in the right part of the geological depositional wedge. So if you can find these sorts of plays, I'd say the maybe it is worth taking a risk on them. But keep in mind, opportunity cost. You're giving up the development plays trading at 2 to 3 times cash flow in order to take on that risk. And that's going to be up to the investor. What are you looking for here? Are you looking for these massive offshore discoveries, or are you looking for onshore development? There's also offshore development plays that could be interesting. But again, I don't look at them in as much detail to make a comparison because I know onshore Canada, and I believe that the geology there is just fantastic, worth pursuing from a junior cap producer at this time when they trade so cheap.
Shubham, your website is whitetundra.ca. For listeners that aren't familiar with your work, what could they find there?
Yeah, so on my website, I am a fully disclosure. My portfolios are on there, both my White Tundra portfolio and my personal portfolio. I also have articles I've written in the past for Seeking Alpha and also for the website that are on there. And then my Sunday seminars. So every Sunday or second Sunday, I host a session completely free, no sign up required. Just attend over Zoom or on Twitter Spaces. I talk about all kinds of topics: company valuation, acreage, well by well results. My most recent one 2 days ago now, was on Q4 reviews and junior company outlook. My next one is on offshore development worldwide. So all kinds of topics. 2023 is going to be focused on more petroleum engineering topics. 2022, all the recordings are on YouTube. It was more focused on company by company analysis and valuation metrics. So anybody looking to get into the industry in terms of investment, 2022 will be your company deep analysis. 2023 will be your overall topics, petroleum engineering and other ways to conduct business in the oil patch that I have up there. And they're completely up there, for anybody looking to learn more about the industry, because let's be honest, this is a $10 trillion per year industry. It is not something you learn overnight and become a genius. So a lot of interesting concepts need to be understood, and will make you a better investor for the cycle going forward, especially given the volatility that one is to expect when investing in oil and gas in general. And when there's a banking crisis going on, volatility is a word that gets a new meaning and a new definition as well.
Excellent. Well, Shubham, thank you for coming on today's show and sharing your insights.
Yeah, you betcha. Always fun. Thanks.